Hi everyone, welcome back to the US CPA classes for financial accounting and reporting. This is part 8 of revenue recognition. Please go through part 1, 2, 3, 4, 5, 6 and 7 before jumping into this particular video because this is in continuation of all those parts. In this particular video, we'll be discussing in detail about some of the important topic or newly added topic in ASC 606, that is the concept of breakage and installment sale. So let's dive into to understand more in detail about breakage and installment sale treatment in ASC 606.
So, if you remember in the breakage concept, when I was explaining in the very first class of the revenue recognition, we discussed about like loyalty reward, payback, miles, right? Jet miles or air miles kind of program in which like company provide reward points to you which you can say redeem in the future period, right? And those company do use breakage concept. So what exactly is the breakage concept? Sometime the customer may not exercise all of their contractual rights immediately, right? Often referred to as breakage, like loyalty rewards, payback point, discount coupon, which management expect that it will not redeem or will get expire without redemption. For example, like in our earlier example, which we were discussing about loyalty rewards, in which there are so many customer of the banks who are doing the transaction day and night, all 24 into 7, and the million of transactions are taking place every month. And on each transaction, million of the customers are earning the reward point, right? And out of those million, like most of the, like 8 to 10% people are doing the redemption, but around 90% of the people are not redeeming that point and it will get expired. So all the point have the life, right? Some reward point have 6 month life, some have 12-month life, some have 18 months, some have 24 months. These are the general life cycle, which is like industry practice. But important thing here is to estimate how much the customer will be redeeming and how much like company estimate that will go expire. So the revenue can be recognized only of the redeemed points and what the actual expire point and what the company estimate to going to be expired. They cannot recognize the revenue of the points which they estimate will be redeemed in future. So those are active or live points. So that is called breakage concept. So if
So
you see
revenue will recognize revenue or expense.
revenue, so I'll.
No, if there's a point, we'll claim like I have HDFC points on my credit card. So if I claim them, they'll pay me back in cash or maybe in kind. So
Mhm.
that is an incurring expense for them, I guess.
Once,
Or
yeah. So yeah, I'll pass it through. I'll present it through an example. I
okay,
know we all are accountant numbers. We understand easily than concept.
sure,
So
sure.
first one is accrued of of rewards once. Hmm? Second thing is redemption. Right. Third thing is expiry. Hmm? Fourth thing is balance. Hmm? So let's assume in month one, or let's assume year one. So a company, let's assume we are doing for Bank of America. Hmm? Bank of America customer. So Bank of America have, let's assume, 5 million customer, right? And those 5 million customer have earned, let's assume, 5 billion reward points, right? And each reward points value, let's assume 0.01, that is 1 cent, right? That is the reward point value. Generally in US, like that's how the pricing are, right? So now in year 1, so reward points, and now let's do value. So let's assume the total reward points earned during the year by the customer of Bank of America. How much? 5 billion. How many zeros? Is it right? How many zeros in 5 billion? Am I right?
Yes, 7 zeros.
70? Okay. So how much is the value? This multiplied by this, right? Hope I'm right. Yes, sir. Okay. And let's assume out of this 5 billion points, how much is the redemption? Let's assume 10%. Let's assume 10% is the redemption, right? And let's assume the life of points is, let's say, 24 months. So in this year, let's assume 30% of the points have got expired, so this multiplied by 0.3. Let's assume these many points have got expired. So what is the balance? Total accrued minus redeem minus expired, right? This is what the closing balance will be. Yes or no?
Yes, sir.
Yes,
Yes,
sir.
sir.
Right? Are you guys with me?
We are
Yes,
with
Yes,
you.
sir.
Right? So now this company who is managing the point, let's assume XYZ Limited. XYZ reward points management LLC. That is the company, right? And they have the charges for point management fee and they have, let's assume, commission on redemption and expiry, right? Let's assume they have point management fees of 0.001 cent. How much is it? $0.001. And let's assume same is their commission. Let's assume same is their commission. So what will be the revenue that XYZ Reward Points Management LLC would be recognizing? Are you getting, like, are you understanding what is the business model here? The business model is that bank has its customer, right? And each customer have debit card and credit card. And each time they swipe debit card and credit card, on that they earn reward point, for which bank pay to their customer of 1 cent on per dollar spent. Is it clear?
Yes, sir.
Right? So 1 cent on per dollar they spend. So this is bank paying to their customer. But XYZ Reward Points Management LLC is managing this entire show. For management of this entire show, they might be taking management fees and some commission, right?
Yes, sir.
So their management fees and commission is $0.001, 1 cent, and same is the commission. So how much will be the revenue that XYZ Limited will be recognized based on these facts?
So points management fee will be charged on the basis of accrual of reward points. And commission of redemption and expiry will be charged on redemption and expiry points. And combination of both will be the revenue component.
Total revenue. Yeah, absolutely right. So here, the point management fees will come this multiplied by 0.001. Right? Make sense? As and when the points are being accrued. Right? Everyone agree to it?
Yes, sir.
As and when the points are being accrued and they get into their system, then system will automatically manage. So there's no major remaining performance obligation. Right? Now coming to the commission on redemption and expiry. So at the time of reward point, there is no commission, right? At the time of redemption, that is this much point has redeemed, multiply by 0.001. So this will be their commission. And same is the case of expiry, right? But now they said, I have this huge chunk of 3 billion points. Do I recognize the revenue for them or not?
No, because that the revenue has already been accounted in the first hand, where we have charged points management fee.
Commission revenue.
Commission will
Commission on
not be charged, I guess, because that's not been redeemed or expired.
How about others?
Same, sir.
Yes, sir. नहीं होना चाहिए था commission में.
But all of you, your answer is wrong. Here, the breakage concept says you can estimate out of this balance how much will be expire. And to that extent, you can recognize revenue here. So let's assume.
तो redeem का भी हमें estimate लगाते होंगे कि how much we can the points could be redeemed.
But yeah, for redemption, it's your liability to transfer to the vendor, right? For example, if you are a Bank of America customer and in future you redeem the reward points, you go to the Domino's, buy a pizza, then I need to pay to the Domino's. Then my this performance obligation will satisfy. But if it is getting expired, then I have no major performance obligation left. Getting my point? Because of the performance obligations.
So we have to justify Domino's, that we, according to our estimation, these many points will be expired and
No,
this
no, no,
is
no,
the
no,
revenue
no,
will be
no, no,
recognized.
no. So there are two things. One is your bank, right? Who is giving the reward point. Second is chain of vendor. That can be your Domino's, that can be your Pizza Hut, that can be your H&M, that can be your TJ Maxx, that can be your Boss, that can be like any Samsung, right? So there are like ton of customer who is accepting this reward point. There should be vendor who will be accepting this reward point.
So these are onboarded by the this
reward
management company.
Oh,
okay.
Why the bank will give
Right.
reward management to them? Because they have vendor pool who are accepting their reward point. So there, the business is like that. One side you have bank, Another side, you have pool of vendors who are accepting your reward points, because your reward point.
Okay, so basically, bank will pay to the management company, management will pay to the vendors for accepting
Yes,
the reward points.
yes, when the redemption will happen.
Okay.
Until the time this money is parked in the escrow account. As and when you start accruing the reward point, it is the liability on the bank to park that amount into escrow account. They cannot use it because it's a liability for them. And when it will get redeemed at the vendor's shop, then the management company, this XYZ reward points management company, pay to the vendor from that escrow account.
So,
Getting my point?
is there any cutoff kind of a setup where we like? I'm just like I'm confused. So when they recognize a revenue against accrual points, so accrual points are not being earned by the customers at a point of time. It's over a period of time during an
Hmm.
year, right?
Hmm.
So will there be a cutoff kind of a thing where we'll recognize the revenue?
No, it's recurring.
Okay.
It's
As
recurring
and when the
because like,
points have been accrued, we'll recognize the revenue.
no, again, two things again. One thing is your point management fees. So that you'll be recognizing as and when the points coming into your system, because after that you do not have much performance obligation left because its system automatically calculate.
Okay.
So
Okay.
that you will be recognizing as and when it is accrued. Second thing is payment side or expiry side. So for expiry side, you will be recognizing when it actually expire, and redemption when it is actually going to expire. But third leg is the breakage. That means what you estimate in future going to get expire. That much amount of revenue you can recognize upfront.
So we'll bill the bank against that accrual.
Say that again.
So basically, we recognize the revenue. A
Hmm.
customer spent. So basically, I spent something on my HDFC card, right?
Hmm.
I earned accrual points,
Hmm.
right? The management company on the behalf of HDFC will
Bill
recognize
to
the
the bank.
revenue against
Bill to
that.
the bank. Yeah, bill to the
And
bank.
then they'll bill to the bank, right?
Hmm.
And they'll book account receivable against that.
Yes.
Okay.
Account receivable or unearned revenue. So that we will calculate here. How much will be the receivable and how much should go to the unearned revenue.
And regarding the commission part,
Hmm.
so I have earned now, for example, I have right now I have 4,500 points on my HDFC credit card.
Hmm.
These have been earned over the period of past 6 months, right?
Hmm.
Now tomorrow I go into my application and redeem those points again against cashback, right? On
Hmm.
HDFC, it's like 4 points is equivalent to one rupee.
Hmm.
Okay. So I redeem those points.
Hmm.
As and when I redeem those points, they'll recognize the management company will recognize the revenue and will bill to the HDFC again
Yes,
for the
absolutely.
commission part.
For the commission part, yes.
Oh,
Yes, absolutely right. Whether you take it cash back, whether you go to Domino's, whether you go to Lifestyle, whether you go to Pantaloon, whether you go to Samsung, whether you go to Reliance Smart, it's completely your choice because it's actually, in a way, is cash.
and regarding the expiry portion now,
Hmm.
for example, tomorrow is the last day to like claim those points.
Yes.
Day after tomorrow,
Hmm.
the management company will put that into expiry and will recognize
Yes.
the revenue and bill the HDFC again.
Yes, that is their revenue.
Okay.
Sir, I have
But
just one confusion. Okay.
but the expiry part is already being managed under the points management fee. Why they charging expiry as a separate portion under
Yes.
the
No,
revenue?
no, no. There are two revenues. One is point management fees. Second
Hmm.
is commission on redemption and expiry because they are managing the vendors. So for
Okay.
that, they need some commission, right? For example, if you are redeeming $100 value at any vendor, so I need to pay to the vendor, right? If I need to pay to the vendor, there is some Administration fees, that is my commission.
सर
Make sense?
actually इसमें जब actual accrual हुआ reward points का, okay, so we charged points management fees, okay, one leg completed. Then there is commission part, commission of redemption and expiry, I'm clear with. Now regarding what we are left with, that is the balance of reward points. That number which is being arrived is from the accrual itself, accrual of points, correct? Now we have already charged everything. Why are we estimating from the balance reward points that how much will be
expire in future?
Right. If we estimate that, because we will be charging commission on that. That is the purpose. Okay. And that will be his revenue, which he will be billing to the bank. And then okay. Yeah. So this breakage in here would be of the expiry points in future. Okay.
So here is 3 billion points. We are estimating 85% of it will go expire. Multiply by my commission 0.001 cents per dollar. So this will be my revenue.
तो वैसे तो 85% भी I guess सर ज़्यादा ही है.
So say that again.
सर 85% भी ज़्यादा ही I guess. Near about 90% ही होते हैं इस पर.
Like just a roughly we are estimating. That's a estimation based on past trend and the future industry. You can say awareness, because now people are getting more and more aware about the rewards point and they are trying to redeem it as much as possible. So slowly and gradually trend are moving in a positive direction.
Okay.
Right, everyone? Got it? So what is my total revenue? $955,000 for the year one. Make sense?
Makes sense. Yes.
Cool. So let me add this example also in the notes.
सर ये जो $255,000 जो है वो सर अन रेवेन्यू में आएगा ना सर?
Say that again. No, this will be in earned revenue, and the difference, if you have billed more and you have earned less, then the remaining difference will be come into the unearned revenue if you have billed more. That's based on your payment term basically.
But this is an estimation of the future outcome, right? That these many points will expire in next year, right? Or in the current year itself.
In the future year.
But then it should be unearned revenue instead of earned revenue.
No. This is because in future, for this reward point, you have no further performance obligation left. So you can recognize the revenue. When revenue will recognize? When performance obligations are satisfied. If there is no performance obligation and the amount is not refundable, you can recognize the revenue.
But what if next year we estimated 85% of the points will expire, right? But actually just 40% of the points got expired.
Then you have done a wrong estimation.
So what should be the corrective action against that?
So like estimations always have a prospective impact, not retrospective impact. So it will impact your next year financial statement with the less revenue.
Okay, we'll adjust those extra revenue charged in the last year against the revenue earned in the present year, in the future year, basically.
Yes, that is called change in estimation. So change in estimation always have prospective impact. Change in accounting policy have retrospective impact.
Okay. Got it.
Cool. Let's put this example here as an illustration. Oh boy, got stuck. Or it's taking time. Maybe I'll add this illustration before I send this notes to you. Right? If we start adding now, so it's taking longer time. I don't know for what reason. Okay, so let's continue with the notes. Otherwise, we won't be able to finish it. So now let's go back here. So let's come back to the theory of the breakage concept. Sometime a customer may not exercise all their contractual right, often referred to as a breakage, like loyalty reward point, payback point, discount point, which management expect that it will not redeem and get expire without the redemption. So that's a management estimation of the future redemption of the reward points or the future discount coupon they have given. So they can recognize the expected breakage amount as revenue in the portion to the pattern of right exercise by the customer. Right? Recognizing the expected breakage amount as revenue when the likelihood of the consumer exercise its remaining right become remote. That means the 85% you are expecting that people will not redeem, will get expired. That's your best estimation. That means there is a remote possibility that consumer will redeem more than 15% of the point. Right? To that extent, you can recognize the revenue of those points. Recognizing the revenue for expected lap or expire the right. That's also same. Now recognition of breakage. So recognition of breakage is of two type. One is direct with the consumer. Second is when you are involving third party. If you see the company like Ola, right? If you remember, like initially Ola was giving like, like refer a friend and get some reward points, some Ola points, Ola cash, Ola money, right? Do you remember those days? Yes.
Yes,
Yes,
sir,
sir.
yes, sir.
Right? So in that case, if you see, the Ola was giving the Ola money to their consumer directly without having third party involvement. Right? Same way, when you go to the Domino's, you purchase a Domino's pizza, they give you coupon directly to you, not through any third party. Right? So that is called arrangement between the two parties, and there they record the liability is called deferred revenue. So that means, for example, if you buy a Ola ride of, let's assume, $100, right? On the first ride, they give you, like cashback. Let's assume $30. That's Ola cash. They have given you $30, which you can utilize against the future ride. Same way, when you purchase a Domino's pizza, they have given you a discount coupon of 50% discount for the next purchase, similar to material right. In that case of scenario, how much revenue should Ola or Domino's would be recognizing for the first sale, and how much revenue they should defer it? That is the question here. Let's take another example over here. Let's assume Domino's. Let's take an example of pizza company. In year one, sales of pizza, let's assume they have sold 100,000 pizza, right? Sales price, let's assume $10 per pizza is the sales price. And then discount voucher issued. How much? How much to all? How much? Guys, are you with me?
Yes, sir.
I know.
Discount.
Okay. So how much discount voucher they have issued? let's assume they have issued 50% of the unit sale. These many 50,000 discount voucher. Let's assume they have issued discount voucher issued, which is 50% out, 50% on next purchase. So discount voucher they have issued. Now here each discount voucher is value how much?
Five.
$5?
Yes.
Yes, no, right? So here, let's assume you have sold 100,000 units and you have issued 50,000 vouchers, right? And here you are estimating redemption. Let's assume 10%. So how much is the value you are estimating redemption?
Which is 25,000.
50,000 multiply by 10% multiply by $5, right? 25,000. Everyone?
Yes. Yes.
On same page? So you are giving $25,000 discount to achieve the sales of $100,000. That means in future you have liability to pay to customer almost amount $25,000. Out of this $1 million. So what will be the revenue you will be recognizing? Revenue of year one will be $1 million minus the estimated revenue, and deferred revenue will be $25,000. Make sense? Make sense?
Yes, sir.
Any doubt?
सर आपने
Anything?
सेल वैल्यू ली थी 10 लाख
Sorry?
सेल वैल्यू जो थी that was
1 million.
1 million, correct? And then you reduce the estimated redemption value. The
Yes.
redemption value, that is what we are offering. That is our cost. The discount we are
No,
offering.
no. That is not cost. 50% of the sales price.
सेल वैल्यू ओके राइट वो एक तरह से हमारा रेवेन्यू ही हो गया तो जब रेवेन्यू आएंगे ईयर 1 के तो हमने ऑलरेडी उसको अकाउंट फॉर कर लिया है उसके अंदर ही
So this, yes, this 1 million is the sales value, or you can say collection.
समझ आ गया सर वो दैट इज ओवर एंड अबव जो आप अलग से डिस्क्लोजर हो गया वो डिफर्ड रेवेन्यू का
No. Out of this $1 million, you need to recognize revenue 975,000 and 25,000 you need to show deferred revenue as a liability. Your collection is $1 million. But out of that collection, you have future liability of 25,000.
Okay. Oh, right. Okay. I was just thinking about the one leg of 50%. So that's
right. Everyone, Rahul, Gurmehar, Kashish.
Yes, sir.
Yes, sir.
Everyone understood?
Yes, sir. Yes, sir.
हाँ सर ये भी कॉपी कर दो यहाँ पे ना थोड़ा क्लियर हो जाएगा.
So here I don't know why it's taking so long for this copy paste kind of thing. Yeah, but I'll do the formatting stuff. And under the third party contract, which we have discussed, earlier this way. So here it will be unearned revenue. Right? I'll do the formatting stuff later on. But high level, we got both the examples, right? So under the third party arrangement, when you have like reward points company, then you will be considered this as an unearned revenue in that company account, right? So these are two different nomenclature to, you can say, disclose the liability into your financial statement. Got it, everyone?
Yes, sir.
So under the third party arrangement, like here you are HDFC Bank or Citibank of Bank of America, right? Here you will be recognizing the liability, that payment due to the vendor. When the payment is due to the customer, then it is your deferred revenue. So that is the two difference. One is your current liability, payment due to the vendor. The second is payment due to the future customer. So that you don't know the name. So hence it is need to be recognized as a deferred revenue. Should we close here? Is it overwhelming? I don't mind closing it here today.
Yes, sir. Yes, sir. For
वरना
sure.
heavy लग रहा है, हाँ?
ठीक है सर, कर लेते हैं थोड़ा सा और। छोटे
कर
छोटे
ले?
कॉन्सेप्ट हैं, देख लो सर जो सबका ओपिनियन है मेजर, उस बेस पे।
One second. That's why my system is getting so slow. Okay, so maybe let's no, rest of the things are basically disclosure. I can quickly take you through and then you can read at your convenience. So those are like just disclosure which we have already discussed. So remaining performance obligation, like disclosure part, so you need to disclose an entity in the following things. One is aggregated amount of transaction price allocated to the performance obligation that are unsatisfied or partially unsatisfied, right? An explanation of when the entity expected to recognize that as a revenue, or the disclosure is not required if original expected duration of the contract is 1 year or less. So that goes to breakage stuff, right? Now the disclosure part is full ASC 606 disclosure. What all things you need to disclose? One is contracts with the customer, term of those contract, revenue recognition, point in time, over the period of time, methods of recognition, impairment loss if you're doing, disaggregated revenue or contract balances, performance obligation, transaction price allocated to the performance obligation, significant judgment you have used, right? Those significant judgment may be like selection of the method, selection of input assumption, determining the transaction price, estimation of the variable consideration, allocation of the transaction price, or measurement of the obligation. All the estimate which you have used in entire 606 need to be disclosed in the financial statement. Then performance obligation, what are when entities typically satisfy the performance obligation, like upon shipment, upon delivery, or upon or maybe like over the period of time, all the three things which you have understand over the period of time conditions. So which condition need to be satisfied to consider the revenue for over the period of time, significant payment terms for the contract, or maybe nature of the goods and services which you have promised, obligation of if there is any return or refund policy, what are the obligation, if you are providing any warranty, what are the type of warranty, standard warranty or extended warranty, right? Remaining performance obligation for more than 1 year if you have, then you need to disclose separately. Aggregate amount of transaction price allocated to the performance obligation, unsatisfied obligation or partially satisfied obligation, explanation of when an entity to expect to recognize the revenue. Additional disclosure required for issuer, right? For non-issuer, it's not mandatory, but for issuer, some additional disclosure required, which include any assets they have recognized, like contract assets, any judgment made during the made in determining the amount of the cost incurred to obtain and fulfillment of the contract, method used to amortize, like over the period of the contract, or the earlier first year, earlier 2 year, earlier 5 year, or the later, what exactly is the method you have opted to amortize the cost of the contract, right? Closing balances of the contract, amortization expense, or impairment losses, right? Then disaggregated revenue. What are the types of revenue you have? What is the geographical conditions from where you are getting the revenue? What all market you have from where you are getting the revenue? Type of the contracts, contract duration, timing of the transfer, sales channel. So here is an example given. Let's assume you have like three vertical: consumer product, industrial product, and supplies, from where you are getting the revenue, right? And you have like different market: North America, Europe, Asia market. So that's how you need to represent and reflect in the financial statement. After this, go back and look at Microsoft Financial and GM Financial, which I've shared with you, right? Look at their revenue recognition policy and look at the disclosure of the revenue recognition they have made. You'll see like similar things over there, right? Then revenue from the long-term contract, all those are disclosure part. This, like you can go at your own. But this installment sale may be like a new concept which we will discuss. Yeah, so let's spend some time on installment sale. This is like different than the Indian accounting standard or the IFRS, right? So other things, all we have disclosure, which are very much standard disclosure, and you can go through at your own convenience time. But let's invest some time on the installment sales really quick. So what is installment sale? You are purchasing some item and you are paying over the period of time on an installment basis to the vendor, right? That is the layman definition of the installment sale. So under the installment sale, the recognition of revenue is deferred beyond the point of sale and is associated with the subsequent collection. So here in the installment sale method, revenue is recognized most probably in the cash basis. As and when you receive the money, as and when you receive the installment, proportionate to that installment, you will be recognizing the revenue, but you will not be recognizing upfront at all the revenue. For example, let's assume you have a let's assume a JCB machinery manufacturer. Let's assume you are a JCB company and you manufacture a JCB machine, right? And that machine you sell on an installment sale basis. So in installment sale basis, the ownership is not transferred to the customer until and unless you receive all the installment. First thing is that ownership is yours, right? Second important thing is you will be recognizing the revenue over the period of installment received, but not the time when you are delivering the machinery, right? That is the second major difference. You will be recognizing the revenue over the period of installment, not at the time when you have given the delivery to the customer, because ownership is transferred when you receive the last installment after that, right? As risk and reward has not been transferred, ownership has not been transferred, so you should not be recognizing the revenue upfront. So revenue will be recognized over the period of installment received and in the proportionate of installment received, right? Let's look at this example. So revenue and cost will be recorded in a period of the sale, but defer the profit for the period in which cash is collected. So for example, you have sold a JCB machine for $500,000 on installment sale basis, right? At the time of sale, what accounting entry you'll be making? Installment account receivable debit by $500,000 to installment sale. So you're booking a sale of 500,000 and you're booking a receivable of $500,000. Let's assume cost of the machinery is $400,000. So what will be the entry for that? Cost of installment sales account debit to the inventory. So you are removing inventory, you are adding into cost of goods sold, right? You are debiting cost of goods sold by 400,000. That means difference between two is $100,000. That is your ideally is a profit, right? Makes sense? Are you guys with me?
Yes, sir.
Right? 500,000 is the sales price and $400,000 is cost. So your profit component is $100,000. But when you need to recognize that profit. Let's understand that. So during year 1, you have collected $175,000, right? So what will be the entry for that? Cash account debit to installment account receivable. You are receiving the installment account receivable, you are reducing the installment account receivable and increasing the cash which you have received, right? Simple. So far so good till third journal entry.
Yes, sir.
Now coming to the fourth journal entry at the year end. At the year end, hold the gross profit on the installment which you have not received. Only recognize the revenue, only recognize the profit on the installment which you have received. So what you will be doing? Installment sales account debit, you'll be reversing the sales. To cost of installment sale, you'll be reversing the COGS. To deferred gross profit. So 100,000 will go to the deferred gross profit. Or the other entry what you can make, like simple adjustment entry. You will not change sales, you will not change your COGS. Just make a simple adjustment entry to the gross profit. That is gross profit account debit to deferred profit. So your $100,000 of the gross profit will go into the deferred gross profit account. So that deferred gross profit from this $100,000, you'll be recognizing $35,000 as a revenue of the current year. How this 35,000 has been came? That is 20% of 175,000. How this 20% came? Which is $500,000 multiplied by 20%, $100,000. That is your profit, right? Makes sense? What is your profit? $500,000 minus $400,000, $100,000. $100,000 is 20% of the sales price. Yes, no,
Sir.
right?
Yes.
So 20% of the sales price. So 20% of the collection, 175,000 multiplied by 20%. That is 35,000 is your gross profit which you have earned. So this 35,000 you'll be reducing from the deferred gross profit and entering into the gross profit. So what will be the journal entry? Debit the deferred gross profit and credit the gross profit by 35,000. Right? So this type of accounting you need to make for installment sale. And installment sale accounting in US GAAP is different than the IFRS and NDS. And this is the difference. Here, gross profit is being deferred. Whereas in NDS and IFRS, you can recognize the gross profit if there is no probability of non-collection or you are confident about the collections. Make sense?
Yes, sir.
Cool. So yeah, then we have consignment sale. This maybe we can defer it to next class. So maybe one or two small topic we can discuss in the next class, right? So let's close it. I think you are feeling overwhelmed as of now. Shall we close it now?
Yes, sir.
Gurmeher, Ananya, Kashish.
Yes, sir. Yes,
Yes,
sir.
sir.
Okay, take care. Let's close it here. But like I'll send you the notes. You go through the disclosure part and installment sale. If you have any doubt on that, we can first cover in the next class, and then we'll do the remaining 2-3 topics which is left over. Okay.
Okay, sir. See you.
Okay, sir.